Good day, everyone. Welcome back to Macro and Market Moves. Today we have with us Mr. Seshadri, the Head of Research and Strategist, Emkay Global. Hi, sir. To start with, what is your current outlook on the Indian and the global markets? Do you still think that the long-term growth story for India is intact?
Yep, thank you. I do think that as far as let's start with India. In the short term, I think India is headed for a period of extended consolidation. The valuations are now quite stretched, not only at the index level but many sectors as well. And most institutional buyers are struggling to find new ideas in this kind of a market.
Right.
The longer term view, however, remains intact that India, this is a sustained multi-year growth story for India. And from a 2 to 3 year perspective, therefore, the market continues to look attractive. And our advice is that investors stay invested and wait for the compounding impact to start to resume after a period of consolidation.
That's great. That's great. So, if you look at the global level conflicts, they seem to have, entered the sensitive areas of Middle East as well. So, do you think that this will have an adverse impact on the global energy supplies and impact the markets?
It's a risk, but it's not in our base case. The Middle East crisis blew up almost a year ago, and we've had a year without any profound impact on global macros so far. I'm not suggesting that we completely ignored that, because say if the conflict escalates from here on and brings in more countries, then it will get tight. But I think or I hope that the global players, larger global players, prevail upon both sides to prevent this conflict from escalating out of control to a point where it starts impacting the global economy. Remember, one of the largest Middle East players, Saudi Arabia, is on a reform path, and it is critical that the military stability in that region does not go out of control. So, as I said, it is in our base case that this remains under control, but this is a risk that we're keeping an eye out on. And if it does, escalate and more countries get dragged in, and it sends oil prices, say, to $90-95, then I think there is a risk of some correction in the Indian markets.
Thanks for that answer, sir. Next, China has recently launched an economic stimulus, which is said to be the largest stimulus that it has ever launched. So, do you think that this might be a threat to the China plus one strategy that we have?
No, I don't think so. But again, it is something to keep an eye out on. China is doing two things. Warning is that China is a very difficult economy to read, but it appears they're doing two things: sorting out their internal issues in terms of the property market and stimulating domestic consumption. And as far as manufacturing strategy goes, it is moving to the higher end. So that itself protects some of this and more to finished than intermediate goods, in our opinion. So that helps the China one story continue as far as India is concerned. The second unknown in this pack is that we don't know the outcome of the US elections and what impact that has. We all know that Trump has threatened China with very large tariffs, and if that happens, then the China recovery may be a little stillborn. But net, we don't think at this point, despite the China stimulus, that the China plus one story for India will get significantly derailed. There are challenges, I must warn, in terms of the so-called China one story, but I continue to be very constructive on Indian manufacturing from a medium-term perspective, and the China stimulus doesn't change that.
Because when the stimulus was launched, the market didn't react very well.
Yes, so that is probably a factor of two or three, things happening at the same time. The Middle East conflict flared up at that time, and the worry in China is twofold. One is that whether it hurts India's manufacturing story if China comes back very strongly. The second is whether flows will get diverted to China from India. And my answer to both is no, actually. I don't think India and China compete for flows to that extent. They're different markets. And maybe even that a recovery in China because could help India because it will divert flows into emerging markets. So we are at the cusp of the global rate cycle turning, which typically encourages flows into emerging markets. Flows into emerging markets have been hampered because China is such a large part. Investors didn't want exposure there so far, and therefore, the flows to overall emerging markets have been hampered. So, if China comes back into global asset allocators' portfolios, then there may be a downstream benefit for India as well. So, the market reacted that day, but I don't think the China stimulus or recovery to the China market is necessarily a zero-sum game versus India.
Thanks for summing up, sir. The earnings season is underway. So, what are your thoughts on the sectoral performance so far this year?
So, the headline earnings numbers don't look very attractive as far as the upcoming second quarter earnings season is concerned. But once you dig deeper, it doesn't look that alarming. There are two sectors which are dragging down the overall aggregate. The first is energy, because the oil and gas and oil marketing companies are coming off a very high base. Second quarter last year was very, very elevated, and that will start to, that is preventing. The growth numbers are optically looking very poor because of that. This is the last quarter where that high base is there. From next quarter, it will normalize and growth will come back. The second is cement. This is a seasonally weak quarter for cement. But this time the seasonal weakness is a little more pronounced than normal, which is why, given the thin margins, it has pushed the profit growth down quite alarmingly. But that's again a one-off for cement. If you strip these two sectors out, then your top line growth is about 7-8%, your PAT growth is about 12-13%. It's not particularly alarming. That's where the trend line for the longer term as far as the Indian markets are concerned. So yes, the headline numbers are worrying, but they are due to two sectors. The general trend is quite positive.
Okay. So your latest Indian strategy report, it indicated modest growth for your stock universe. So do you anticipate this to accelerate in the second half of FY25?
Yes, we think that the second half will come back a little stronger for 2 or 3 reasons. First is that from the industrials sector perspective, government capital expenditure has been slow in the first half, primarily because there were the elections, a delayed budget, and a very heavy monsoon.
Right.
So a combination of these three actually depressed capital expenditure for the government, which we expect to pick up very significantly, and that will flow through to earnings through multiple sectors. We just discussed cement, that is also a factor in that process. Second is that we expect consumption to come back a little stronger in the second half. Seasonality is there, so half on half the numbers will still look a little better. And a combination, and as I just discussed, energy had a high base. So if you combine all of these three, we expect the second half growth to be much stronger than the first half. Yes,
that's awesome. With the Fed easing interest rates, the global rate easing cycle seems to be on the radar. So, do you foresee similar actions in our economy? And if yes, by when is the biggest question?
Good question. So, we've already seen the start where the RBI pivoted and changed their stance on liquidity in the last MPC meeting.
Right.
Last week, I think it was. The rate cut is probably some time away. We are penciling in maybe December, but that has two challenges. The first is that the next two, we saw a pretty elevated inflation print yesterday, and there is one more bad inflation print coming next month. So they may give it some time before inflation settles down, before the MPC moves to cut interest rates. So there is a risk that the December rate cut gets moved to February. But the other factor is that global turmoil has typically, when the US cuts rates, it puts pressure on the dollar, it puts appreciating pressure on
Yes.
emerging market currencies, and emerging market currencies therefore have to follow suit so that their currency doesn't over appreciate and hurt exports. That hasn't happened because there is a risk outflow. The rupee is actually under pressure. So that gives the RBI a little more breathing room to pace out the flows according to entirely domestic dynamics rather than worry about global. Now, December is a long time away, and if things change and things settle down and the RBI sees massive inflows coming through as a sort of rupee carry trade, then they may have to take action in December. But by the end of FY24, which is say 6 months away from now, FY25, which is about 6 months away from now, you will probably find rates substantially lower where they are. The exact sequence is a little difficult to predict because there's so many moving parts in this.
Understood. We experienced significant enthusiasm in our Emkay Conference. So how has the momentum been since then in the last 2 months?
Oh, the momentum is fantastic. We are seeing our engagement with our corporates has picked up, on an accelerated scale. Our analysts and me and our senior leadership team have been literally out there meeting many corporates, so there are multiple. So first of all, and the key conclusion is that one, the growth story for India, if you speak to corporates, looks very, very strong. And that's an important input, that the confidence among corporates does not seem to have wavered at all despite a tough first half. And they are all making very, very aggressive. See, it's one thing to say, the other thing is to do. And they all continue to making very aggressive plans for long-term growth. So yes, the momentum is there. Our engagement with our corporates, which is a crucial part of the services that we provide to our investors, is continuing at an even faster pace, and the energy that is there in corporate India is very heartening to see and very encouraging. That's one of the inputs that give me confidence that this continues to be a very attractive market for the longer term, notwithstanding maybe some near-term consolidation.
That's great to hear, sir. Lastly, we have a small rapid fire session.
Sure,
So
go ahead.
you should say one word that comes to your mind whenever I say the following sectors: pharma,
Attractive,
IT,
expensive,
real estate,
growth,
auto,
growth,
ancillaries,
opportunity,
oil and gas,
structural change,
banking,
challenging,
financial services,
opportunity,
defense,
overpriced.
last but not the least, hospitality.
Growth.
Thank you. Thank you so much for your time and patience, sir.
Thank you so much.
Thank you so much for watching our video. Please do like, share and subscribe if you want to watch more such contents.